Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that covers our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Great to be back for another episode, and great to be joined by our most frequent returning guest.
Yes.
He was our very first guest, generous enough to give us his time when we knew nothing. And he continues to give us his time when we still don't know that much.
Don't know about that.
That's it, Ren. It's our absolute pleasure to welcome back for the last episode of 2021 before we get into our summer series. Andrew Brown, welcome.
Thanks, Bryce. Morning, Ren.
Morning.
So for those who haven't heard of Andrew before or have just joined Equity Mates for the very first time, welcome. Andrew is the Executive Director at E72, an NX-listed LIC, and as Ren said, a regular guest on Equity Mates. Now, as tradition has it, we always get Andrew in at the start of each year to bring some bold predictions along with ourselves. And in today's episode, we're going to be closing out the year by reviewing some of the bold predictions that we made, having a look at why valuation still matters in the eyes of Andrew, and then looking forward to 2022 wrapping it all up. So can't wait.
Absolutely.
Yeah. Valuation still matters. You wouldn't think that's a controversial statement, but hey, we're in 2021.
Well, I think as we've moved through 2021, I think that's been proven, I think, quite clearly. And as things are changing into 2022, I think you're going to see that there's more of that as well.
Yeah, well, let's look back before we look forward, though.
Yeah.
So at the start of the year, you came on and you shared some bold predictions with us.
I did, absolutely.
And some came off, some didn't.
That's right.
So let's go through
So
it.
Let's go through. Yeah. What I wanted to do is to really take what I think are two overarching lessons out of the bold predictions we made at the start of the year. And please remember, before you throw tomatoes at the computer screen, don't forget, we did these they were broadcast on the 4th of February. And of course, I don't get the chance to change anything.
Well, let's also be clear, we
yes.
ask for bold predictions.
Absolutely, yes, indeed. So the first overarching lesson is I've actually brought a book today, which is the sequel to Peter Lynch's original book, which is called One Up on Wall Street, which was published in, I think, 1991. And the sequel is called Beating the Street. And in many ways, it's like some of the films where the sequel's actually better than the original. Okay, and in my opinion, the sequel's better than the original here. Now, the reason for bringing the book, and there it is, 1994, yellowing pages and everything. Okay, towards the end of the book, it's got Peter's 25 golden rules, and I've used this golden rule so many times it's not funny.
Okay.
Okay, and it's golden rule number 19.
Okay.
Which is, quote, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you're invested. Okay? So when we do bold predictions at the start of the year, please bear that in mind. That I can tell you the economy's going to do X or Y, but you should know that some of the companies that you're looking at, the economy has no impact on whatsoever. Okay? Viruses may, but the economy may not. Okay? And I think you're going to see that's a really overarching lesson from looking back, but also looking forward. Secondly, the other overarching lesson is with interest rates basically at zero still, it seems that valuation doesn't seem to have mattered until this year. Okay, and everybody said, it's a great business model, it's a great business model, it's a great business model. And all of a sudden, and you guys fabulously did it, I think less than a week ago, when you published a table of, great business model companies like, Zoom Communications most obviously, where the stock, of course, has gone from 560 down to 200, call it. Okay, and there's a load of others have absolutely fallen off the shelf in a big way. Some because the business model is nowhere near as good as what people imagine, but in the case of Zoom, it's a pretty damn good business model, as I think we all know, but people are paying way too much for it.
Yeah.
And as interest rates go up, because they will, then valuation is going to matter more. So if you pay too much for this stuff, you're going to lose out. And in that vein, I think just one of the runs back, and Ren is trying to hide under the table because he's going red. If you go back and listen to the 4th of February, Ren chopped me off extremely brusquely.
Really? That sounds
when I mentioned an 8-letter name called Afterpay, and I mentioned that Afterpay was ludicrous, and Ren basically said, "Well, going into that."
To be fair, we were wrapping up the episode, and I didn't want you two to get going.
That's right. Anyway, the upshot was at the time Afterpay was $146.75, and it's been taken over since, of course, and the stock at the time of speaking is about 106. Okay, which goes to show you that even with a takeover, and even with the business growing and losing ever more money, then basically valuation did matter. And it's quite clearly mattered in the rest of that BNPL sector, as we know. So, if you own Zip at that time, you're underwater. And if you own Sezzle, you're positively drowning.
If you want to hear some unfiltered thoughts on Sezzle, follow Andrew on Twitter.
Yes.
But I should just ask, with the Afterpay thing, I don't want to get bogged down in buy now, pay later. But isn't a lot of that tied to the fact that Square is one of the businesses that has fallen off?
Absolutely, of course. And Square's fallen off. But even when Square was going okay, I mean, the full-blown takeover was no more than what we were taught, the share price back in January. So there you go. Just to put some perspective on this, by the way, when we made the broadcast back in February, the ASX 200 was 67.65. So the return from there is about 6% at the time of broadcast, and the Standard & Poor's 500 was 38.71. So we're up about 18%.
So I'm not sure if you just saw Bryce shaking his head, but he's on a real vein about how pathetic our index is compared to the US.
6%.
Why would you expect?
Why
would you expect any more, Bryce, in 2021? For the simple reason, so much of the index is 4 banks and 3 major retail
exactly.
companies.
We don't have giant tech companies.
The 4 banks. I mean, one of the 4 banks has done extraordinarily well, which is Combank, because it's got great management, it's got a strong business model. But even it's sort of canoeing in treacle a bit at the moment with interest rates still low. And what you've also got is the resource companies. One of the things we saw, and it's remarkable, within 2 weeks of bold predictions going to air, the world had changed completely on the 18th of February. China. We said China was going to be a major feature, and we'll come to the 5 major things. And China really changed from the 18th of February onwards, and we're going to why and how and everything else. So let's go to the bold predictions and see how we went. So we said politics are going to play a real role in equity markets. Well, I think that was spot on right. They did. Okay. Why did they play a big role in equity markets? Because politics kept central bankers, sort of drinking the juice, both in Australia and in the United States. So in the US, most obviously, the deficit goes up and up and up and up as obviously the government tries to kind of repair COVID. But obviously, that continues to be funded still, despite the tapering. It's only a tapering by the Federal Reserve Board. They're still net buying bonds. Okay, it's just they're not buying as much. So that I think they've been under the political thumb, and so that's played a great role because it's kept interest rates down. And what's been extraordinary is that as interest rates have kept low, the 10-year bond basically in the whole year, it was 1.1 when we spoke. It's been to a high of about 1.75. It's currently about 1.5. Okay, but the inflation rate's gone from nada to 6.2%. Okay, and the core rate, if you exclude...
You're not even making a return on the ASX with the inflation rate like that.
Yeah, absolutely.
No, well, Australia's inflation.
Yeah, I know.
The core rate's 4.6. Let's use the proper rate, okay? Now, this is really relevant, okay? So the real 10-year bond yield in the US is minus 4.7%, okay? That is the lowest since probably both your sets of parents were still at school in short pants and had never met each other. 1974.
Yeah.
In 1974, I can tell I was at grammar school. Okay.
Yeah.
And of course, that was when we had the oil crisis, when oil was much more important to the world economy, and it was cost-push inflation, because basically what was then the Arab cartel pushed the price of oil up dramatically, and that had a massive impact on derailing growth and obviously creating inflation and creating a stagflationary environment, which you've had wheeled out. So the big question is, nothing's changed from February, except the inflation's much higher. Governments have got to extract themselves from the corner that they and their central banks have boxed themselves into. And you've had a few hints recently that that's proving difficult. Let's take two examples specifically. In Australia, Philip Lowe basically had to stop buying the April 2024 bond, which he already owns 62% of the issue, and has cost Australian taxpayers $2 billion so far, with mark-to-market losses and actual realised losses. And that was part of his yield curve control to keep the 3-year yield at 0.1. That's stupid. I'm sorry, that is stupid. You're going against global markets. He can print money in theory, but they have much more. Okay, and basically the world started betting against him because they knew it was a one-way bet. It was nowhere near equivalent to George Soros in 1992 and sterling. Okay, it was so obvious that rate was crazy, and so the rate went from 0.1 to 0.7. And the other thing is, obviously, very recently we've had Jay Powell starting to say, "Well, this inflation thing's maybe not transitory." Well, Jay, wake up, sonny, well done. Everybody else has been saying that for 4 months, mate. So we've got a problem, and we're still there are a lot of the rates are where they were in January, February. Okay, but inflation's now much higher. And inflation is a mix of three things. It's demand pull, quite clearly. So we've, the world's woken up from COVID by and large, and forget Omicron. We'll get through that. Okay. So the world's woken up, number one. Number two, you've had cost push inflation because you've had supply issues. You've had droughts for, in Taiwan, which, push up the price of computer chips, etc. So that's cost push. And then thirdly, I think what is starting to happen, which is the most dangerous bit of all, is that inflation expectations are starting to go up. And once expectations get into the community, then the community starts saying, I need a pay rise. Because things are going up. I think things are going to keep going up. I want a pay rise. And so it gets into the labour market, and that's an issue. Okay. So I think, once again, in 2022, we've got to try and get out of this corner somehow or other, and it's not going to be easy. And it is going to involve equities coming lower at some stage. Okay. So the dislocation thing has not happened in 2021. Let's make it clear. We have not had a 15 to 20% dislocation. Might be in the middle of one as we speak.
Let me ask you about that, though, because let's take the US, for example. A dislocation of 15 to 20% in the index just means that these 5 or 6, well, it's like 8 now.
7. It's about 7.
Yeah, these giant trillion-dollar companies that just seem to print money. Need to fall off for the index to fall off. Yeah. If you normalise the index without them, we probably are seeing it.
That is a brilliant point, because you've as you guys have pointed out, and as I'll touch on, you've had a massive fall off in what you might want to call the second line tech stocks. In not just America actually, but globally. And one of the global aspects is really crucial, and I think gives you an opportunity. A great opportunity as well.
But on that, like, I don't see Apple falling 20% if they just have such operating leverage and they can keep growing. Same with Microsoft. Like, maybe it doesn't because they're so big. That's
right. Apple, I mean, they're 25%. I mean, you've got what I now call sort of man-mag, with Meta obviously being the start of it. And you need to add to that NVIDIA, which has obviously been the runner, and a car company whose name
I was trying to come up with an acronym, and it's like it's ANTMAMA now. So there's not a lot of letters to use to create something good.
One of the things that, look, the big thing is, I mean, and Apple is probably the best example of this, okay? Apple's earnings have been rated upwards and upwards and upwards and upwards, okay? And even when you've had a little bit of a shudder because of what's going on elsewhere in the world, which to some degree is out of their control, which is chips, you know, the stock's still pretty close to a record high. And the reason why is because they've got the business model that, you know, everybody wants, and, you know, one of your recent guests from New York sort of outlined it really well, which is basically you have a high margin business which is by and large recession proof, and then what you do with the cash flow is you basically keep buying your own stock back, and you have sufficient cash flow to do that. And, you know, you need to model out Apple for about another 5 years before you start to really say, oh, you know, the sort of the net debt is starting to get up there, and, you know, maybe they need to stop. You know, and if somebody puts a spanner in the works, it would be too risky. But you've got to go out that far. And you can't really do that with Google. You can't really do that with Microsoft. I think potentially you can with Netflix because there's a lot more competition.
Yeah.
I think you can with Tesla. And Nvidia you can as well, you know, because the rating now for albeit an outrageous chip maker, it's brilliant, you know, is so very, very high. But yeah, you're absolutely right. There's 25+% of the S&P 500 are in these really vastly strong companies where, you know, they will, you know, they're getting up there in terms of valuations, okay, and eventually people will say, oh, it's a bit too much, but you know, it's hard to see what the spanner is that derails some of them, not all of them, some of them. Yeah. Okay, regulation is the obvious one.
Yeah.
So we didn't get a dislocation.
No.
Okay. I gave you something which I said this is 100% certainty, and it's turned out to be absolutely zero. And again, things had changed really quickly within a few weeks of broadcast, which was a federal election in Australia. And the reason that was relevant for markets is because at the time, the Liberals and Scott Morrison were very much riding high, and it was really, look, go early, go now, get another 3 years, and we've got, you know, basically what I think is a pretty predictable set of economics that they put forward, whether you think they do it well or not so well. Well, of course, then, you know, by then we started to have these stroll outs, you know, the extremely slow rollout of vaccines. We started to get COVID too. A few governments were a bit slow, and of course the economy then, you know, went down the tank. So it struggled more than we think. Fantastic prediction, completely from left field. You know, of course, I didn't predict COVID too. We also said 2021 was going to be the year of takeovers. Was it what? None of the three stocks I postulated to be taken over, which we'll come to, but there were tons of takeovers, and part of that, of course, was aided by the fact we had COVID too. So you had what we said was takeover, you know, really takeover positive, very low debt, lots of it available, and some diverse equity valuations. But the takeovers have basically been made by private equity who've got the cash, and of course, you know, one of the bigger takeovers for this year's Sydney Airport, not yet finalised, but of course by our, you know, not-for-profit super funds, you know, getting together and buying a long-term asset. So, and there's been a stream of other takeovers. You know, I've been the lucky recipient of a few along the way. I don't mind saying, including the cheapest takeover in Australia at an enterprise value to EBITDA multiple of 2.5.
What was it?
That is Prime Media, which is the Channel 7 rebroadcaster in the regions. And that, of course, is being taken over by Channel 7. Sort of put it into a half Nelson with press.
That's like the Riverina and stuff, isn't it?
Yeah, it's New South Wales, it's Victoria, it's WA. It's pretty much everywhere, not completely everywhere. But, you know, of course, it's, you know, as everybody says, oh, what do you buy that for? It's a lousy business model. Might be a lousy business model, but when you're buying it with an enterprise value of less than the price of a Sydney house, you know, and it was spewing out. I mean, just amazingly, was sort of, you know, spewing out $20-odd million of EBITDA. It's just fantastic. So it had $40-odd million of cash. So that was great. That was really good. But there are a lot more like that, and, you know, obviously the other big one was Afterpay. And
you got in on that, didn't you?
No, didn't get in. I wasn't sure, which was good. But it's a very logical takeover. the piecing together of the two businesses is very logical. And of course, I think that nobody's spoken about this really, but unwittingly, I think the market started to realise that as Afterpay's joined together with Square and CommBank's gone into, sort of pay in full, let's call it. Yeah, what it's meant is the competitive environment in that space now is just furnace-like.
It's hot, yeah.
And the other guys are going to struggle.
Well, to speak to personal experience, I've never used Buy Now, Pay Later, but I use PayPal for a lot of my internet transactions, and I almost used their Pay in 4 because it was just so simple. Then there was one step that made it more difficult, and so I didn't do it. But I was like, that's going to be a real challenge because people like me, I'll never take the step to sign up to like an Afterpay or a Zip, but it's there in my workflow already.
If you're not in, Afterpay's going obviously, but if you're not in, say, Zip, and that's struggled as well, share price wise. You really have to. If you're in some of these other third line players, please, you need to look at the business model, and because I've been so vociferous about one in particular, which is Sezzle, because Sezzle's got a very peculiar funding structure. What I find is that young people that invest in these BNPLs do not understand the funding structures. Okay, now Afterpay is very easy because it's basically 2 or 3 warehouses, National Bank, Goldman Sachs, plus its own equity. And it had unlimited access, I believe, to capital, particularly early in the year. But some of these other guys don't. And if you don't have access to capital, you've got no business whatsoever in this space. So if you're holding some of these things, even though you may be losing money, please go through the business model. Please work out why your particular BNPL favourite's going to be a winner. And if it's not, get rid of it. Seriously, because it'll go to zero. They will go to zero, some of these things. So anyway.
Taking a step out of Buy Now, Pay Later, this whole experience for me has been a real reminder of like that it pays to pay for quality a lot of the time, and like getting the number one in the space often is the right decision, even if it's more expensive. That's right. Because I've fallen into this trap. So many retail investors fall into the trap of like the second one's trading on a cheaper multiple, and like all it needs to do is take a bit of market share, and then but like
you're not the only one that falls into that trap.
But this is a real reminder that
it's also a real reminder. Okay, the things that have killed BNPL have an application elsewhere. Okay, the thing I focused on as a negative for the sector was the cost of customer acquisition was skyrocketing, and I mean skyrocketing. So again, if you're the 5th line player in this, and Afterpay spending 20 odd bucks to get one customer, what are you going to do? Anyway, so let's move on from that.
So let's just wrap those 5 and then perhaps move on to valuation. Still matters. So we had, just to close it out, politics to play a big part in the equity markets. Correct.
I think that's a tick.
Dislocation of 15 to 20%. Didn't see
Volatility stayed high, but it's implied vol rather than realised vol. Big difference.
Potentially a 2022 though. Federal election in Australia.
Well, I can guarantee 100% that's going to happen in 2022.
Australian economy to struggle more than we think. Correct. But for different reasons.
Yes, correct.
And 2021 to be the year of the takeovers. Correct as well.
That happened as well. That happened. We also had other things, okay? The other things we had China, okay? That China was going to be really important. I want to come back to that because I think there is a real opportunity there now. We discussed it in the context of Taiwan, so it wasn't, that wasn't quite where we're at. We talked about COVID incompetence, okay? I think to some degree that happened. So it sort of did have an impact on our economy. We also talked about the fact there'd be a bank takeover. Well, there sort of was because Bank of Queensland bought ME Bank. That's cheating. I do want to make one other great point about what's gone on here because our 3 takeover stocks we had were Simic. That's down 28% from the broadcast date to today. Treasury Wine Estates, that's up about 17%, and Deterra Royalties is about it's down about 6%, but you've had a dividend, so we'll call it flat between friends. Okay, so none of those have come off, which I think illustrates a few things. First of all, don't just bet on a takeover. There's got to be something behind it. But secondly, there's another lesson in there because I did make one other comment when we were talking about takeovers. And I did say to you, quote, you won't find a small cap fund in Australia that doesn't own Mainstream. Mainstream at the time was 98 cents. And there was this enormous takeover battle between Apex and SS&C. And the eventual takeout, and there was no takeover on the table, by the way, when we made that comment. And the eventual takeout price was $2.80.
Wow.
So it was not quite a trebling.
Yeah.
Okay. So that teaches you another lesson, which is you can have all kinds of crap in your portfolio, but if you have a diverse portfolio and you have one or two things make it, bingo, thank you very much, you will still have a winner. So all of you who bought Mainstream after the 4th of February 2020,
Unfortunately,
I'll give you my PO box number and send a check.
Andrew, it's okay because everyone knows that there's no buy, hold or sell recommendations on this, so this is all do your own research.
This is all do your own research. So if you did your own research, you did very well at that.
Moving on to valuation and why it still matters, Andrew. You've certainly been a value investor since the day we've met you. You've taught us a lot in that space. So why does valuation still matter for you at the moment?
It matters a great deal now because interest rates are really not going to go much lower. Okay, they may trail around at this level for a while. Okay, but they're not realistically going to go any lower. And so the thing that maintains high multiples for good companies is realistically not going to get any better. Okay, and what you've started to see is where there's been even a minor hiccup for some of these very, very good companies, you've had a quite significant dislocation in share price. And as we've touched on already in this, we've touched on the second line tech stocks in the US. Let's just look at one, okay, because I think it's really instructive as to why valuation matters so much and why getting the business model right matters. And that one is Peloton, okay. A fund manager in Australia called TDM I thought was very, very brave, and I am in no way critical of them at all, okay, because they've got a super track record. They were brave enough to publish, and you can find it very easily on the internet, their thesis around Peloton, okay, when the stock was about 90 odd, I think. Okay, I'll stand to be corrected on that. It had come down from 167.
We'll chuck, because we've shared that link a few times. We'll chuck that in the show notes. So if people want to follow along, they can pull that out.
And I think it's really instructive because they shared with you why they thought Peloton could get from its prevailing customer base of about 2.3 million up to a customer base of 25 million over a 10-year period. Okay, and they went through the sort of arithmetic and the reasoning behind that. And I looked at that and I thought, wow, you're really brave guys, okay? Because I couldn't, I love your reasoning, I love your work, and I couldn't disagree more with it if I tried. Okay. And the simple, the simple reason is, and I think Australia's brilliant. Australia's a great example of why. Peloton's come to Australia in a big way. Walk through Martin Place. No Tesla showroom there, it's a Peloton showroom. I think Peloton's got no hope in Australia. I don't know why they're here.
Why is that?
Simple. We have sunshine. We have sunshine.
I mean, the US has sunshine as well.
Not in Boston, it doesn't, pal. You reckon it has sunshine in Boston in February? No. I can understand why Peloton does really well in, for example, the northeast of the US. I have no issue with that at all. Okay, if I lived in Chicago in a nice big unit, I'll have a Peloton. Okay, in Sydney, Melbourne, by and large across Australia, we're an outdoor country. Okay, a lot of us have proper bikes. I don't. A lot of us do a lot of other things. We're an outdoor exercise country. Okay, this is for indoor exercise countries. Plus, it's expensive. Plus, I love it because the alternative costs nothing. It's called walking. Which I do lots of,
Yeah, but in defence of them, you could say everything the same about spin classes and gym classes
absolutely.
And gyms full stop.
I'm not questioning TDM or their reasoning. I'm just saying I disagree with the conclusion they reached from that reasoning. Yeah. But the problem was, if you disagree with the conclusion and it looks as though Peloton is going to be stuck in low single digit customer numbers not moving towards 25 million over 10 years or 12 million over 5 years, at $165 a share, the valuation was completely cuckoo. And I'm going to contrast it with another major tech company later on in this podcast, Spotify. So what you had is Peloton started to fall apart. And because there was no valuation metric to justify where they were, then as soon as there's a bit of a problem, they're not growing as quickly as they thought. And, just go to the Peloton quarterlies and you can see that very, very clearly, particularly how poor the latest one was. Then, the shares, that's why the shares halved in a week.
Yeah, and what, they're down 75%.
Yeah, and they're down, I mean, they're basically 40 now,
Yeah.
down from 165.
Yeah.
But they were 90 a matter of a few weeks before this broadcast. So, they're the kind of things that happen. People say, oh, no, they don't. Well, they do. Okay. When people like me started to question Sezzle's funding model, the stock doesn't come off a little bit. I was short the stock at $10.50. I wrote a negative piece out on the company, which came out at $9. And the stock's now got a 3 in front of it.
Wow.
Yeah, they don't fall 10%. They fall 50 or more. And a lot of them have already done that. But with interest rates probably going to stay, they may stay low, but they're on the increase. You've got to get your valuations right.
Yeah.
Okay. You've got to really try and get that right, because the business model per se, unless it's amazing, may not save you.
Yeah.
May not save you. Some will. I acknowledge one of Peter Lynch's other rules is basically, don't worry about a quality company getting a little bit expensive, because if you just sit and hold for a year, the earnings will catch up. Okay, and then you'll get rocking and rolling again. And there's of course been plenty of lessons about that over the last little while. I think valuations for me. The old world, one of the features of 2021 is the old world has caught up a bit. There's been some stellar performances from stocks that, by and large, the millennial and Generation Z audience would have thought are the most unholy pieces of excrement.
Do you want to give us an example of that?
Yeah, I'll give you an example. If you were ferreting around in the rubbish tip in sort of March, April 2020, and you sort of figured, oh God, what's in the rubbish tip? There's 2 old world media stocks. You could have bought New Zealand Media at 25 cents. They're $1.35. And because they're actually not just an old world media stock. And of course, the best of the lot, because, Gen Z and Millennial don't know what this is, there's, when they're all sort of on podcasts and everything else, believe it or not, there's sort of at 8 o'clock in the morning, there's kind of Nat and Kochie broadcasting from Martin Place. You could have bought 7 West Media at 6 cents in April 2020 because everybody thought it was going broke. Okay, and thanks to some superb management, cost cutting, and obviously people being glued at home and they're glued to the news and the media and everything else. The stock recently touched 66. So it's up here, 10-fold,
10 bagger.
from the bottom. And their debt is now sufficiently low that they're paying cash to buy the prime media assets.
Yeah.
Of course, prime media was 9 cents and they're being taken out at what's effectively 36.
Yeah.
And, because of the way it's done, there's a bit more money in it than that, actually. So that's a 4-bagger from the low. And I mean, prime media is the worst business model in Australia. no
Worse than Peloton?
That's the worst business model in Peloton. But the valuation's good. So, as a retail investor, how do you approach valuation? Okay. Valuation, look, it's there's not just one way. Okay, we all know the theoretical value of a company is the discounted future value of cash flow back to the equity investor. Okay, but there are lots of shortcuts to that, and particularly when companies own loose assets like properties and things of that nature, you've got to value those separately. Okay, so to me, what it means is that whether you're doing DCFs, which are not hard to do on a spreadsheet, or whether you're doing much more sophisticated valuations like me, what it means is you just need to be a little bit more conservative. you've got to build in just a little bit more, higher interest rate, not quite as aggressive a growth rate perhaps, going forward, because what you're going to find is that that's what the key people in the market are going to be starting to do. They're going to be starting to pull growth rates back. They're going to be starting to, demand a higher return. Okay, and so must you. And so you can't just get away with, it's a great business model any longer. You couldn't last year, and it crept up on everybody.
Yeah.
No question. I mean, if sorry to stress BNPL, but it's the best example in Australia of how it crept up on people. They're going, why is my zip not going back to $9?
I think the Alphabets and the Amazons and the Apples of the world really poisoned a generation of investors' minds around, having a great business model will make everything okay.
Yeah, but what you've got to remember Apple, as we've said, Apple reinvests their cash flow in stock buybacks by and large. Sure, they pay dividends. Alphabet's the ultimate sum of the parts company. It's not easy to do. Nobody's saying it's easy to do. It's the ultimate sum of the parts company. You've got, effectively search and ad. You've got YouTube, which is now broken out. You've got all the other bets. You can start to put numbers on some of the other bets. Some of them get partly monetized. Okay, but he's the ultimate sum of the parts company. And so, one of the reasons, you've got to remember, by the way, Alphabet has absolutely lapped virtually all the other. Certainly if you go back to the big five, as it was, it's lapped the other four this year. It's up over 70% this year.
Yeah.
Okay. And that basically is a mixture of the strength of the business model and the earnings coming through, and that has vindicated people's sum of the parts valuations in that case. Okay. So approaching valuation, I think it's important in the sense of basically you need to be a bit more conservative in terms of actually how you do those valuations. Just be a little bit more wary about Mr. Lynch's advice here about letting stuff grow into the valuation. Don't throw things away, but don't go adding to your positions in stocks without being a little bit more disciplined, would be my viewpoint.
Yeah. And when you say be a bit more conservative, do you mean a higher discount rate?
Yep.
Is that the main way?
There are two obvious ways that you do it. A higher discount rate and a slightly lower growth rate.
Yeah.
For your, for your cash flows or earnings or however you're doing that.
So on the discount rate, there's some people that will, you look at like what they want in terms of expected return or cost of capital. They might look at some just will have a fixed number. Some people will say 10% is just a standard discount rate and that works. How do you approach setting a discount rate?
Depends on the industry, quite clearly. I'm prepared to be a little bit more liberal when I think there's genuine growth in the industry, and I think the industry is at a real turning point, and I'm going to give you an example of that as we go on. Whereas in other industries, for Prime, for example, I assumed it was going to get when its franchise was renewed in 18 months' time, and so I just did a cash flow at 5 years, and I stopped it there. And so that was about the most conservative thing I can think of. So just a 5-year cash flow, the cash was declining, and I got it to a stage where I said the company's making a loss on cash, and so it's going to close down. And I still got much more than the prevailing share price, so I was, happy player. So, there are things like, it really depends on the industry. Okay?
Yeah.
So, basically, I often, you said, just a standard rate, 10%. That's not the stupidest thing in the world to actually do. That's not really that crazy to do. It may sound crazy if you're in a very, very growth industry, but it's kind of markets like this when they dislocate. So when markets dislocate, you might be in a hefty growth industry, but the share prices come down so much that you get your 10% desired return. In an industry that's growing 10, 15, 20%. Okay, and I think the one thing that I will not shy away from is that dislocation in industries, not in markets, but disruption in industries, the pace is not slowing.
No, that's the thing.
The pace is not slowing. So you've got to remember, let's use BNPL again. This is Harvard Business School stuff for a few years time. Because BNPL's come in as a disruptor okay, only a matter of a few years ago, Australia's obviously been its major proving ground, and it's been disrupted already. Why? Because the big guys sat back, let the small guys lose a lot of money. One came out of the pack because their management was far better than the others, you know. It's done a deal where basically, you know, it's ending up with a two-way business model, you know, with the merger with Square, okay, and the others are going to be left in the dust, and the big banks have now come into play, okay, and PayPal's come into play, and so it's meant that all these fintechs, all these small guys that were going to come in and, you know, make, you know, they've made their founders a ton of money because some of them are, you know, and I bet none of you read the prospectuses of how much money got taken off the table when you put your money in. So some of these guys don't care anymore because they've made 20 and 40 million bucks already. So if the company goes bust, it doesn't matter. Okay, there's a few need things to work, but you know, it's what's critical is those guys have been disrupted already, and they were going to be the disruptors. Because the payment system's not that. I mean, let's be blunt. It's not that sophisticated. You know, you don't need 88 ways, you know, for me to give Ren money. You know, I can already do it instantly through Osco, which is obviously you know, part of BPay. You know, so except through National Australia Bank, get your act together, please. You know, I mean, you know, but Westpac, you know, Ren will have money in 10 seconds from me via Osco. Yeah. So why do I need some sophisticated payment system, you know, run by a bloke wearing his baseball hat backwards? Oh, sorry. You know, you simply don't. I mean, there's other things, you know, to do with crypto, to do with foreign currencies, and to do with stocks and linking stocks to instant stuff. So there's things like that. There's only so many ways you need it. And so the disruption in part of that sector is already over. It's finished. Yeah. And disruptors have been buried, or some of them. Yeah. So be careful because things are changing at such a pace that you know, you can't just sit there going, hey, you know, I'm on the disruption train. Well, you're not. You've just been, you know, your carriage has just been unhooked.
Yeah.
Now, Andrew, I'm conscious of time, so let's move to looking at 2022. Yep,
absolutely.
And some of the key things that are playing on your mind.
I want to get people to have a look at three areas which I think have got potential. Two I'm going to cover very quickly. One I'll just enunciate a little bit further. Okay.
Sure.
The first is China. Okay. On the 18th of February last year, basically pretty much the Chinese market peaked out. Okay, I think we all know what's been going on in China. It's basically the two words common prosperity, which means equality, which means obviously all kinds of reforms instituted by President Xi. We've obviously had slower growth, and that's had an impact on Australia. The iron ore price peaked out at, depending on which measure you use, around about sort of 230 in early May. It was about 170 when we spoke in February, and it's now 100 US per tonne. Okay, so that slower Chinese growth has had an impact, and that's why our market's been a bit sloppy, because obviously it's pretty hard if you're BHP or Rio. And you're not a meme stock like Fortescue, you know, to make forward progress. Okay, but what's really happened is, of course, the China internet market really peaked out in the middle of February.
You're telling me, Andrew, my stock of the year was Tencent.
Yeah, you're down 38%
I know.
as we speak from the 17th of February. Okay, I mean, Alibaba's down over half. It's down about 55% from then. The China A50 index, which I find probably the most useful, that's down 25% from 2 weeks after we made the podcast earlier in the year. The Hang Seng index is down roughly the same. It's down 24%. I think there's a great opportunity there. Okay, these companies are not going away. They may have had their wings clipped, absolutely. They may have to make more donations to the government, absolutely. But they're now not expensive. What's one of the best ways to play them? Okay, there's something called the Crane Shares CSI China Internet ETF. And Tencent, JD, and Alibaba are three of the four biggest holdings in that. They're cumulatively about 27% of it. It's the stock code is KWEB. Okay.
I'm assuming over in the US.
Over in the US.
Yeah, right.
Okay, so it's a US ETF. It trades on the NYSE ARCA, where most of the ETFs over there trade. I own it, obviously, and I bought it relatively recently because think about what's happening to these companies when they're down. The smallest decline since February's JD is down 20. Okay, think about them versus their US counterparts.
Yeah.
Plot yourself a gap of the NASDAQ 100 will do because the big 5 or 6 are 40% of that, and KWEB, which is an ETF.
Yeah,
it's just there's no vice in this. It's
Yeah.
just widening and widening and widening, and yet by and large they do many of the same things to a different populace. I think that's a real opportunity now. It's contrarian, I acknowledge, but I'm there.
So one thing, whenever we post about like Chinese companies on our Instagram or in our Facebook group, the big question from the Equity Mates community is all around regulatory risk.
Yeah, absolutely.
How do you think about that, and how do you factor that into your analysis?
It's got to come in terms of price, the price you pay, and when these stocks are down, 40 to 50%, on what? Regulatory risk. Because with the exception of Alibaba, that's basically what it is, because JD, for example, is still growing very, very strongly. Alibaba, I acknowledge the growth rate has come off a little bit, so excuse me, that's taken on board, but that's what's caused this dislocation by and large. And don't forget, it means your China market's down 25% at a time the US market on the NASDAQ is up 25 plus. Okay, so there's a real gap there. So in my opinion, I think there's a real opportunity there that hasn't been there for quite some years. So, and the easiest way, rather than just jump on the Alibaba horse, for example, is as usual with these things, because it's a thematic rather than explicitly saying this company's so cheap. It's a thematic. So you buy an ETF.
Yeah.
The second ETF, you would never have imagined 4 years ago that I would have come in here and said this.
Here we go.
But there we go. Is the Advisor Shares Pure US Cannabis ETF.
Okay.
Really?
Yeah. Why?
Jeez.
It's really out of favour. Okay, it's had a little bit of a bounce recently, and just with market volatility has gone back close to its lows. But we're very close now to federal deregulation of cannabis. Okay, or federal legalisation of it. Why is that important? There are 6 states in the US where there's no legalisation of cannabis, and so. The other 46 there is, but it's really hard if you're a cannabis producer or synthesizer or whatever, because trying to get banking is really difficult. If you go to JP Morgan and you say, "Hi, it's Andy Cannabis Limited," like the two guys in the movie, they get shown to the outlet very quickly. So I think the cannabis space is really interesting. And again, don't bet on one company, because I think, as we may have discussed before, even here, growing cannabis is not a really strong business, but synthesizing it and distributing it is. So, and this thing obviously covers all and sundry. So I think that's really interesting. I have a holding in it. It's at a low. MSOS is the code. MSOS is the code. And thirdly, I do want to really have a little bit of a look at one industry which came to fruition this year.
Let's get into this, because
this is really fascinating. In the Australian press, you would not have known this even existed or happened. Okay, but the music industry is at a tipping point now. The music industry peaked in 1999 when Napster came in, which you might remember was the original movement from vinyl to CDs to streaming. The trouble is, it was obviously illegal. Okay, and what people used to do is download from Napster onto a CD and cut their own CDs. And the turnover in the music industry basically has never been that high, and it fell. It really fell into disrepair. In many ways, because of the distribution network. And what's happened because of streaming not just Spotify, but Apple and the two arms of Google.
Yeah.
It's really growing again. And of course it's growing again because all kinds of people like, for example, Peloton need music. TikTok needs music. So they've got to license it. Okay. So one of the biggest flights in the world this year, where it never mentioned in the Australian finance media. Astonishing. This is a 46 billion euro company. It's called Universal Music Group. It has 32% of the intellectual property in music. Okay. There are two other main players. They're Sony with 21 and Warner Music, which has got Led Zeppelin, which must make up about 15 of their 16% market share. Okay. So UMG was spun out of Vivendi, which is a French company. Vivendi is controlled by Bolloré. Bolloré is controlled by Odette, and Odette is controlled by itself. Okay, so it's part of Vincent Bolloré's what are called Breton pulleys, where each company controls itself. Okay, if you want to see how that works, go to the E72 AGM presentation for the 23rd of November. I show you how each company owns 50% of each other on the way down and 50% on the way up until you get to Odette, which is publicly listed and we have a shareholding in, and it trades at a quarter of what we think it is worth. It controls Bolloré, which trades at half what we think it is worth, and it controls Vivendi, which is at least at a 40% discount of what it's worth. Vivendi spun out, it has 2 billion euros of cash. It spun out Universal Music Group to Tencent, Bill Ackman, and the general market. It's listed in Amsterdam and it kept 10% itself. Universal Music Group controls, as I say, the IP. So if Ren forms a band, so we've got Ren and the Renettes. Okay? So Ren and the Renettes go out there and they're quite good, and Universal Music comes along and they say, Ren, we will give you $1 million for your first 3 albums.
Undervalued, but
okay. Until Ren and the Renettes earn back the $1 million for Universal Music, okay, they have no share in what goes on after that. They get $1 million up front, but they got no share in anything after. The intellectual property is owned by UMG. That means they license it to whoever. Okay, so it's not just licensed on radio and things like that. It's licensed, as we've said, in all kinds of other income streams. And what's happening is the music business is really starting to grow rapidly now, okay, because of that factor. And UMG control the IP. How? Why? Data. These guys are so big, they can see, hey, Ren and the Renettes, they're really, really going well in Kazakhstan.
That is our home market.
That's your home market. So what happens? They put all the advertising and everything into Kazakhstan. You'll be doing endless tours of Kazakhstan, etc. The bands make their money from tours and merch.
Yeah.
Okay, 20% of UMG is music publishing, which used to be the cash cow of a lot of these things. So if you remember, you've seen legal battles about who owns the publishing rights to Beatles songs and things like that. So what's happening is UMG are buying more and more stuff. They bought Bob Dylan's back catalogue. So, Bob Dylan has basically no further interest in his music catalogue. Okay, they own the catalogue. And the catalogue, because as you Generation Z people know, all the music you listen to is made in my generation. So it's all about catalogue.
Not true. Bryce listens to a lot of Doja Cat.
There you go. Of course, they've got new artists like Taylor Swift and Ariana Grande and people like that. So UMG's floated. It was floated at 18. It's about 25. That's euros. And the discounted way to get into it, because it's not the cheapest company in the world, it's about a P of 40, but it's a very reliable income stream, is through one of the Bolloré companies, either Vivendi, Bolloré or Odette. They're all quoted on Euronext in France. Okay, so I've got that. Spotify's the other side of it. That's why this stuff's growing. That's why Universal Music Group is growing, because their market, the distribution of music is, whilst people still buy vinyl and the aficionados still do, the distribution of music is through streaming. And the reason people are so cynical about Spotify is, of course, it's one of the very, very few companies, like a Twitter, for example, that has a massive user base that doesn't belong to Apple, Google or Microsoft. Okay, so Spotify, to give you an idea, Spotify has 172 million premium subscribers who pay on average about €4.40 a month to listen. Okay, and they're miles ahead of Apple or the Google stocks. Okay, miles ahead. Okay, because they have a genius as well called Daniel Ek, who runs the company. They're profitable now, and the great thing that's growing Spotify is podcasting.
Yeah.
And that's only really come along in the past 2 years, really, in terms of the growth of podcasting, okay? And we know how cluttered podcasting is. I walk to work 2 days a week, okay? I listen to investment podcasts, but I also listen to podcasts on English football. And wowza, if you think there's a lot of investment podcasts, my God, you don't know how many there are in English football. I've heard everything about Manchester United is possible to hear in the last 3 weeks. So that is an enormous growth business. These guys are, they're basically, they're now making money. They have no net debt. In fact, they've got $3 billion of net securities and cash. It's a $42 billion enterprise value, roughly. But I think when you line that up against other things, it's actually not that expensive. For an industry that is still somewhere in the vicinity of only 2/3 of its peak in 1999. And if you think you're going to live in a world without instant access to informed commentary on whatever it is, or just... I don't want any informed commentary this morning. I've got a hangover. I just want music. And it's going to, eventually, of course, it will completely... There are two industries from the past that have survived every attempt to kill them. Okay, one is cinema, and I think that will still go on and will still never die. And the other is radio. And I think radio's on its last legs.
Yeah.
Radio is on its last legs now.
Yeah.
So we're big fans of Spotify. I don't know. I think you do, Bryce. But it's had a tough year.
It's had a tough year. And that's why it's interesting.
Down 40% from February, down 25% in the last month. Yeah. So what are you saying the market's not saying? Or why is the market saying this company differently?
The market, look, the stock got over-owned when it was 365 roughly, okay, back earlier this year. So the stock got sort of over-owned and everybody was just too eulogistic about it. Compare what I've said about Peloton, okay. So at one stage Peloton had a bigger market cap than Spotify. And if you're telling me the total addressable market of $5,000 bicycles plus, $50 a month, whatevers, is bigger than Spotify, well, we can have a seriously robust debate because it's not. I think what's going on now is quite clearly some of the growth stocks are being hit. It's being just put in with a basket of that. There's ongoing cynicism about Spotify that, that there's a battle, if you will, that it's a zero-sum game between, let's say, Spotify and Universal Music Group. I disagree profoundly with that thesis.
Yeah, because isn't the model that it's like a percentage of Spotify's revenue gets distributed to the publishers?
Yeah, absolutely.
So like their incentive structure is to drive Spotify revenue.
Half of UMG's revenue
is from Spotify.
Comes from streaming.
Yeah.
And the biggest stream is Spotify.
Yeah.
They need Spotify because that's what's changed UMG's landscape. Okay? That's what's changed music's landscape.
Yeah.
That's what put music on a growth path.
So incentives are pretty aligned to that.
Incentives are extremely aligned.
Yeah.
In my opinion. Other people will produce a thesis where they're not. There are so many good podcasts about both of these companies which are analysed in detail. Patrick O'Shaughnessy has done 2 of them.
Yeah, Business Breakdowns.
Business Breakdown on UMG.
Yeah.
Please listen to that. And you understand what a business model really is then. And he's also interviewed Daniel Ek as well.
Yeah, he's interviewed him twice, and Daniel Ek hasn't come on our show, which is a real real thorn in our side.
He should be alongside the obvious, Tim Cooks and people like that. He I think is absolutely fantastic. Finally, look, I've got a couple of fallen angels in Australia. One is trading on 14 times earnings. Its currency is in US dollars. It's benefiting from what's happening at the moment, which people have forgotten, which is Ansell. It's one of Australia's best run companies, 15% return on invested capital. And so when you compare that to the rest of the Australian market, I think that's really cheap. So it's fallen angel.
Wow, it's only trading on 14 times
only
earnings?
14 times. Remember, the earnings are given to you in US dollars, mate. So it's 71. That's pretty cheap. The other one, which I think I've discussed in the past, is Lend-Lease. I do believe that as we get over the virus and perhaps this Omicron thing's giving you another opportunity to have another play in a few things, then basically people will gravitate back to their community, okay? And I think people will gravitate back to where culture is, and they will not live by the seaside. I acknowledge there are reasons to live by the seaside, and yes, you can work from there, but people crave relationships with each other. And I think that means that cities which have stopped growing will now start growing again, and Lend-Lease is the prime builder around the world. It's one of the great builders around the world in urban renewal. So obviously you can see what they've done in Sydney and Melbourne. Sydney's Barangaroo, which is by and large built by Lend-Lease, but they've got huge projects in London, San Francisco, Milan, and other places as well. The shares are less than half of what they were 21 years ago.
Wow.
Okay.
Jeez, that's a tough 21
That's
years.
a tough 21 years. There are some reasons behind that and everything else. They've got a new MD, and I think they're particularly interesting. They're a very difficult valuation play.
Yeah.
I've looked at them for years and years and years, so I've got a bit of an advantage. But they're the kind of two things I'm looking at in valuation space: fallen angels, but not non-growth companies in Australia.
Love it, Andrew.
There you go.
We got there.
I think final word.
Yeah.
You may have gathered, if I'm looking at Spotify, if I'm looking at Bolloré, which is a conglomerate, if I'm looking at Chinese internet stocks, if I'm looking at cannabis, Australian property developers, and basically, protective glove manufacturer, is that telling you something? That in 2022, you are not going to be riding a single theme, as you maybe have been able to in 2021 with the big 5, 6, 7 or 8. Okay, you are going to have to be eclectic and esoteric in your investing. You're going to have to look in corners you may not wish to look at. Okay, but pull the spider web away and have a look what's behind it. That's what's going to be important, because I think it's going to be that kind of market. It's not going to be easy. Okay. Finally, I have an apology to make to someone who will not listen to this podcast. His name is Bindi Chadha. He's the global market strategist from Deutsche Bank in New York. And on February the 4th, it was broadcast that I thought, whatever Bindi Chadha is smoking, I want some of it. Because his earnings estimate for the S&P 500 when the consensus was 165 for 2021 was 194. And guess what, Bindi? You are wrong, because it's 204.
Wow.
And that is why the US market is up 20%, because the one thing I got badly wrong last year was I said US earnings overblown back in February, and no way, no. They were 165 estimate then. They're going to come in over 200.
Wow.
Okay, and that's what's driven your 20% gain in the US market, not a re-rating from PEs and things like that. So to Mr. Chadha, my profound apologies. And on that note...
Well, love it, Andrew. Thank you so much for your time, as always. Plenty of insight for us to digest.
Absolutely.
We're about to hit a bit of a recording break for Alec and I. We are doing our summer series, though. We've got 12 episodes coming up, diving into some of the companies we spoke about. We have Peloton. We managed to get the country manager into the studio to speak with Karen. So stay tuned with that. Plus a bunch of other amazing companies from both here in Australia and over in the US. And Andrew, we'll have to get you back stick with tradition and do bold predictions for 2022 when we're refreshed and ready to tackle the year next year. But as always, thanks for the support and
thanks,
and
guys.
for sharing
Absolute
it.
pleasure to be here, and Happy New Year to everybody.
Thanks, Andrew.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.